Hey, what's up, my friend? So, in today's episode, right, I want to share with you three of the biggest candlestick patterns myths, right, that many traders they fall for, right? So don't fall for this, right? So, myth number one: candlestick patterns, right, predict what the markets will do. Candlestick patterns, right, can predict whether the market is going up higher or lower, and that's a myth. Why is that? Because if you look at candlestick, if you understand it right, candlestick simply tells you, right, what has happened for a given candle. Let's say you see a hammer. For that candle, it simply tells you that at a particular point in time, if it's a daily chart, right, the buyers, right, for that day have took control from the sellers, right, and pushed the price higher, closing higher for the day. That's all it tells you. It's not going to tell you that, hey, over the next week, the next month, the market is going higher. It can't predict that. So don't make the mistake of thinking candlestick patterns, right, can predict what the market will do next week, next month, or next year. It can't do any of that. If you want to predict what the markets will do, right, your best bet is to understand the market structure. In other words, look at the trend. If the price has been steadily, grinding higher over the last 200 candles, then guess what? Next week, next month, right, the price is likely to continue moving higher. And that's your best bet, right, to predicting what the markets will do. So don't rely on candlestick patterns, right? Rely on market structure. Rely on the trend, right? That will give you a much closer prediction. Number two, right? The second myth is this, is that candlestick patterns, right, is the same as price action trading. And nope, right? That couldn't be further from the truth. So let's break it down, right? What exactly is price action trading, right? You've heard that term, thrown all over the website, all of different videos, forums talking about price action trading. So what exactly is this? So according to my own definition of price action trading, it might differ from somebody else, right? Price action trading is, in essence, right, understanding the market condition and then using the right trading strategy to trade that market condition. So if you think about this, right, price action trading is not really a strategy, a fixed set of strategy. Rather, it's a way of analyzing and trading the market. So let me give you an example. If you see the market, let's say it's in an uptrend, then as a price action trader, you want to be buying the pullbacks, right, and selling into the rallies in an uptrend. And if you take things a step further, if you classify the trend as a strong uptrend, you might be willing to buy the breakout of the swing highs, right, and maybe ride the trend as long as the strong trend remains intact. So that's what I mean by price action trading. First and foremost, you analyze what the market condition is and then find the right trading strategy to trade it. On the other hand, right, if market is in a downtrend, then as a price action trader, you look to sell the rallies, sell the breakdown. Can you see where I'm coming from? So compared to candlestick patterns, right? Candlestick patterns, it's I would say a subset of price action trading, because as a price action trader, there are a few things that you want to be aware of: the market structure, the area of value, what's the entry trigger, and the entry trigger part, right, is where candlestick patterns can come into play. Because as you know, right, candlestick patterns, they can serve as an entry trigger to get you into a trade. Maybe you're bullish, you want to buy. A hammer, right, could be the signal that you're looking for to time the market, to enter the market. So this is where candlestick patterns comes into play. So I would say price action trading first at the top, right? Then candlestick patterns is a subset of price action trading. Make sense? Okay. Moving on. The last one. Candlestick patterns, right, is a leading indicator. That is something that you might heard, right? Oh, Rayner, indicators are lagging, moving average, stochastic, RSI, they're all lagging tools. You should look at the candlestick patterns instead. These are leading indicator. And again, that couldn't be further from the truth. Why is that? Because if you think about this, right, whenever a candle has formed, let's say a weekly candle, the price has, let's say, closed higher, you have a bullish engulfing pattern. Well, guess what? The move has already happened for the bullish engulfing pattern to form. In other words, you are trading something that has already happened. The market has already closed higher, and that's how you get your bullish engulfing pattern. So if you think about this, this is actually a lagging tool as well. I mean, it won't be as lagging compared to a moving average or an RSI where they take into account your mathematical formula, but in the grand scheme of things, it still is a lagging tool because it has already happened. So what exactly is a leading indicator? A leading indicator can be like the stock markets. For example, before the economy goes into a recession, the stock markets usually fall first because of expectations. So the stock market can be a leading indicator for what the real economy is doing. Or how about support resistance? Before the price comes into support, you can plot that level ahead of time in anticipation that buying pressure could come in and push the price higher. That is another leading indicator. or even maybe Fibonacci extension, right, where you can project the extension ahead of time to find, where, selling pressure might come in to, push the price lower. These are leading indicators. Okay, they are not foolproof, right? It's not 100%, but that is, my definition of a leading indicator, right? Before something happens, right, these indicators can already sort of like, project or predict, right, what's going to happen. So clearly, right, candlestick patterns is not a leading indicator because the move has already happened. But that doesn't mean that candlestick patterns are useless, because as I've shared earlier, they are useful to serve as an entry trigger to enter a trade. They are useful, right, to help you so-called feel what the market is doing. Is volatility contracting? Is volatility expanding? And stuff like that. But be aware of the limitations of the tools that you're using, right, including candlestick patterns. And that's what today's message is all about. Okay, so a quick recap. Number one, candlestick patterns, it cannot predict, right, what the markets will do. If you want to predict what the markets will do, look at the market structure, uptrend, downtrend, etc. Number two, candlestick patterns, it is not price action trading. It is more of a subset of price action trading. It's useful to act as an entry trigger to get you into a trade. And finally, number three, candlestick patterns is not a leading indicator. It's a lagging indicator. Although the degree of lag, right, it's faster than moving average RSI, but the fact is still that candlestick patterns, it still lag the market. Alright, so with that said, I've come to the end of this episode. I wish you good luck and good trading. I will talk to you soon.